Hi, guys. Welcome to this latest session covering the US election. Of course, it wasn't long ago that we were wondering who was going to be taking the hot seat. Well, we now know, and the answer is Donald Trump. Markets liked it, that's for sure. And we were talking in the previous session about how the key to it could be exactly what happens with Congress. It looks like Donald Trump has taken both sides of it. So, in actual fact, markets view this as the best case scenario. I'm going to be joined with Timothy Carey once again as we try to break down exactly what this means for markets, what kind of markets are going to do well or poorly out of this, what are the repercussions from an FX perspective, how we're going to be looking at things in terms of commodities and single stocks. A huge amount to get through, loads of slides, loads of data that you're probably not going to see anywhere else. So make sure that you stick with us for the next hour. Timothy, do you want to introduce yourself and kind of give us a minute about how you're feeling right now with everything and how it's worked out?
Yeah, my name is Timothy Carrier, market analyst at Scope Markets Kenya, and it's another session, another enticing session. Having the results, having known the winner, Donald Trump. Of course, we are in the era of Trump trades, and I feel excited myself. And just today morning, I was chatting with someone and telling this person that in the next 4 years, if you don't make a substantial chunk of money from these financial markets, then you might never get another chance to have to make such money, because the market tends to favor Trump, and we might see some good moves in the market.
Yeah, the market definitely favors Trump. Here's the breakdown in terms of how it was this morning. We're still yet to see confirmation on the House, but it looks very likely that we're going to see Donald Trump taking the House. And that's something really that allows him to essentially do what he wants. And crucial to this is that, we're talking about, is Harris bad for the markets? And we're saying, well, actually, it's only if she takes both sides of Congress. Is Trump good for markets? Well, particularly so if he takes both sides of Congress, which is exactly what he has done. So it provides the basis for everyone to feel particularly good about themselves. And what happened yesterday? Well, it was the best post-election day on record in terms of the S&P 500, massive gains. There's implications. This is just a handful of them. So I thought that we'd sort of take a look at what this could mean on both the upside and the downside in terms of markets. Low corporation tax is going to be absolutely key for this. A cut for businesses provides greater profitability. You could say that on a sort of high level front, where big companies, of course, now they're going to make more money. But on the bottom end of that, and we saw massive outperformance in terms of the Russell 2000, small companies that are barely profitable are suddenly going to be able to sort of push themselves into a better financial position. So certainly we saw big outperformance on those small cap names yesterday. Extension of the 2017 tax cuts for people within the country, looser regulations is a perception of what's going to happen. Tariffs on imports, that is good and bad. Bad for people that have products that are being created abroad and they're having to bring them in. Also, the potential for inflation. But for US domicile companies that are creating goods in the country and serving primarily the country, is going to really benefit them. Pressure on some companies to relocate back to the US, exactly what I'm saying there. In natural fact, that's bad for some US markets. It really depends on exactly how their supply chains are. Supporting traditional industry, potential strong defense spending. The flip side of it is, and we've seen that in terms of some of the movements, we're going to talk about that, is higher inflation. Do we see higher inflation? And what does that mean for the Fed? We've just seen 5 minutes ago, the Bank of England cut interest rates by 25 basis points. And we're expecting the same from the Federal Reserve. But expectations from the Fed have changed a lot in the last month and a bit. And Donald Trump coming into power and potentially being able to enact all of his sort of expansionary policies is by its nature inflationary, and it puts less pressure on the Federal Reserve to be doing the heavy lifting, so to speak. Higher oil production, that's potentially good for companies, but it's not necessarily great for oil prices. We did see weakness, and we saw a bit of a rebound yesterday. We'll talk about that as well. Deportations, this is something we covered in the last session, that actually if you get rid of a lot of people within your country, you're likely to see lower GDP and potential for deflation off the back of that, or disinflation. But how much of that comes to pass remains to be seen. And then higher spending. You're looking at higher spending. It's good for the economy, but higher deficit alongside that, higher debt. What does that mean in terms of treasury yields? Again, something we're going to touch on, and what does that mean for the US dollar? Timothy, anything you want to discuss around this stuff?
Yeah, I think it's quite interesting to see how these policies are going to, how Trump is going to implement these policies, because as much as we have the good part of it, we also have the bad part of it. And basically, maybe to emphasize, in terms of high spending, which might actually lead to, I'm looking at it that if we have more high spending, this is likely actually to lead to a higher deficit or the US debts. And in terms of market impacts, we are looking at maybe probably this might cause higher interest rates. We might see maybe reduced fiscal flexibility, and also there is potential for future austerity. So basically, just like we were talking last time, whether Trump is inflationary or maybe, so I'm looking at it in terms of the inflation rate might increase, and the reason why we might see less of the Fed, especially during the Trump's regime, this reign for the next 4 years. I was also trying to figure out, to look at when Trump was in power last time, from 2017 thereabout, we saw he kept increasing on the interest rate. The Fed kept increasing on the interest rates. I think around near 2019, when he was nearing the election time, when we saw the Fed began easing. So I'm looking at the same cycle repeating itself. So we might see a lot of more interest rates in terms of the Federal Reserve. And basically, that is likely going to affect the market significantly.
Yeah, I mean, I guess the role of a prime minister or a president is to try and do what's right for a country. And sometimes that can be looking to push for growth. And sometimes that can be raising taxes and trying to rein in the expenses. I get the feeling that Donald Trump is not the guy that's going to be trying to sort things out. Excuse me. I get the feeling that Donald Trump's not the guy that's going to try and heal the world in terms of green policies and bring down carbon emissions. And I don't think he's going to drive down debt either. Both of them, arguably need to be done, but it's most likely that's going to be pushed into 2028, whoever follows him up. So this is the initial breakdown in terms of some of the moves. We saw strength in terms of the US dollar, strength in terms of the US 10-year yield and bond yields across the board, and strength in terms of US markets. Like I said, the S&P 500 ultimately having the best post-election day on record. The implications in terms of monetary policy have been this. This is the expectation for October of next year. So in a year's time, where are rates going to be? The dark blue bar is current expectations. And as it gets lighter, that points towards what the expectations were a day ago, a week ago, and a month ago. So from left to right on each section, the left is the nearest what the expectation is now, and the right is what it was. And what you'll see is all of the outside opinions in terms of like major rate cuts over the course of the next year have largely gone, and the repricing has moved more towards less rate cuts from the Federal Reserve. And that all comes down to the Trump trade that we've seen, and in particular Trump winning this by such a landslide that ultimately we've seen him take both sides of Congress. So this plays into expectations for the US dollar in particular as we go forward. And you can see here, as we went into this election, we saw as the expectations of a Trump victory rose, so the inflation swap, so pricing for inflation expectations also rose. So there is a view within markets that Donald Trump brings inflation, and inflation is not good for markets, quite frankly. So this is going to be something that, we talk about markets every day of the week. Inflation is going to be absolutely front and center, because he's going to have to try and straddle the idea of wanting to see the US economy boom, and that's going to be good for stocks, with the fact that he needs to keep inflation relatively subdued unless he wants the Federal Reserve to stop cutting rates or ultimately have to raise them once again?
Yeah, my view of this is actually beginning with today's rates. Of course, today's rates does not come because of the Trump, because, Trump is going to take office in 2025. That is January 20th. But I think because today we have the FOMC, the Federal Reserve interest rates, again, anticipating a 25 basis cut. I think today's impact might be limited in the markets. Looking at what the dollar index performed yesterday, we saw the dollar index soaring high. Actually, it has never gained that way in the last 8 years. So it was such a huge gain in one day. So the outlook moving forward by the Fed will be likely be key for now, but markets may be hesitant in terms of what to expect ahead. So the reason simply being that when Trump probably assumes the office in 2025, what might likely happen is that we might see the Fed outlook face significant changes. This is guided by the tariffs and the inflation concerns for the Trump's regime. So, like I said, we might see less of easing or less of activities in terms of the Federal Reserve, because again, with the policies in place, the buzz of the market is that most probably inflation gonna skyrocket, and therefore we're gonna see the interest rates maybe even going higher.
Well, that's the thing, though, right? We don't know that inflation is going to rise. Right now, markets are expecting that to happen. And at some point, markets need to react to actual data rather than expectations. Same kind of thing with China, right? Everyone's sort of reacting to these stimulus announcements. We haven't seen the Chinese economy boom, but people start buying in anticipation of that. So let's look at the outlook for indices. First and foremost, this is a breakdown in terms of the performance over recent elections between the election day and inauguration day. I'm going to put this onto full screen so you can see it a little bit better. By and large, markets generally rise over that period. It's something like 2.5 months from now. So you're looking at a 2.5 month period where generally markets rise anyway. And we're looking at a very bullish scenario for markets right now. So I would say this provides the backdrop for people to feel pretty good about markets right now. Here's a breakdown on exactly why I've always believed that stock markets are the best place to invest, but best place to be trading, because there is an innate trend that lies within that, and that is essentially earnings and earnings per share. So earnings of a company can go up or down, but by and large, when you're looking at, say, the S&P 500, there's so many companies that are not only growing, but also managing to enact significant buybacks. When you have a major buyback, as we see from lots of the big tech names, it means that they're reducing the amount of shares. So earnings per share, therefore, will increase even if your earnings don't go up, as long as you're limiting the amount of shares you have in issuance. You can see the trend in terms of earnings per share for the S&P 500 continues to move upwards, and that provides the basis for further gains for the S&P 500. So if we have expectations of further upside for earnings, there's a view that it should provide the basis for strength for US markets. This is the breakdown for the forward PE ratio. So essentially, from historical standards, the US market is very expensive, right? So if you've got a company that is at a price to earnings ratio of, say, 10, then over 10 years, they should be able to earn back their price, right? And so the higher it goes, the more so-called sort of rich or pricey you would deem the market to be. And there's a potential for it to snap back. Of course, when something like this election happens, people can say, well, it may seem elevated, but actually I think that the future earnings are going to be much higher than they are at the moment. So yes, it's expensive by historical standards, but I would say if you look at what markets are feeling at the moment in terms of that election, that still provides the basis in my mind for further upside. Here's a chart that I provided last time around, but it's one that's particularly relevant. It's the breakdown in terms of the S&P 500 after each of the last, 8 elections. And we can see that the best scenarios so far have generally been either a full sweep for Republicans or a split for the Democrats. We've seen the full sweep for the Republicans. So the next 3 months, which does tally up with that view of what happens after the inauguration, a lot of the times, the next 3 months, by historical standards, should be positive for the S&P 500. And by its nature, that probably means strength for the rest of the US markets in particular. Coming into the election, we already had the best pre-election year on record. And then, like I said, the day after the election, we've had the best day on record as well. So really, this has been a particularly strong year coming into this election anyway. And certainly, we're moving into a period that from historical standards would generally be good for markets anyway. So I'm personally bullish for markets. You're talking about, if you can't make money over these next few years, then, it's going to be difficult for you at other times. But certainly everything seems to be lining up for the bulls at the moment.
Yeah, well, as looking at bullish for the markets, especially the indices, I think this was signaled yesterday when you saw the S&P 500 jump about 2.1%. Dow Jones was up 2.6%. Nasdaq 1.8% up. Russell 2000 was about 5.9%. So I'm also looking at a bullish sentiment in terms of the indices. And one key thing that I've always noted is that irrespective of anyway who wins the elections, we have seen that the indices have always performed well, irrespective of whether the Republican or whether the Democrats. But again, what is of essence here now is what will determine the face of how they are going to bulb is now the implementations of the policies that Trump has and how those policies are likely going to affect the market. But the overall sentiment, I'm also bullish.
Exactly. Right. Here's some more charts for you. I feel like I'm just feeding into this bullish narrative. So this is the breakdown for all in the last 50 years, all of the bull markets for the S&P 500 that have lasted more than 2 years, because we're now 2 years into the current bull market. And you can see that with this red line on the left, by historical standards, there still could be plenty of upside to go. Some people will say, well, we're at record highs. We've been 2 years in this bull market. Maybe it's time for a significant pullback. Look, by historical standards, we've got many bull markets that have performed for much longer periods of time and see much more significant gains. So I still think that despite the fact that the price to earnings ratio is elevated and people can say it's expensive, and you can say that we haven't actually seen anything from Trump that has actually kickstarted a change in terms of these businesses because he's only just won. Well, I think sentiment can carry us the first bit, and then his actions can hopefully carry us on the next leg from here. And you can see by and large, in terms of historical norms, generally the back end of the year is a good one. But you can see here, also, the 6 months after an election generally is a good one. So when we look at seasonality, September's often a difficult month for US markets. As people come back from holidays, you see repositioning of portfolios. October generally kickstarts the next bull market. And then on election years, generally October you can see a lot of jitters, and instead you see the bulls coming really kicking into play in November once you see the election result. This time around, we've seen bulls dominating throughout October as well. And you can see here that generally it's not only your November and December period that's strong, as seasonality would point towards. You can see that actually the 6 months following an election generally see outperformance compared to the 6 months prior to it. So this was something that you alluded to, Timothy, which is that overall out of the US markets, it was the Russell 2000 that managed to perform the best. And it's an interesting conversation really to be had, because it's a question of whether right now we should be buying into big tech names or big industrial names or financials, or on the flip side, businesses that something like 30 or 40%, I can't remember the exact figure, of the Russell 2000 are loss making. So we're not talking about profitable businesses here. You're talking about small up and coming companies that are trying to become something, right? And so people took a view yesterday that those companies should receive the biggest boost, despite the fact that we've seen this big surge in terms of treasury yields. So borrowing costs on the rise for companies that rely heavily on borrowing. So do you think that this is the beginning of a rotation into smaller companies, or do you think this is going to be a short-term flash in the pan?
I think for me, I'm looking at it's an opportunity for these small companies basically to at least soar up. Though right now I would because the stocks of these indices are to yesterday they jumped up even the stocks. So the key thing is to, like, for instance, right now, not like buying right now, but waiting for a proper buy. Basically, that's we say you buy the dips. So it's all about a matter of trying to get a proper entry, because yesterday was maybe basically as a result of what I call maybe a hype. So we definitely expect some maybe retracements, like you saw what happened with the gold. So we saw that the hype because of the elections hype. So, but again, for the small caps, it's something that you cannot be able to ignore. And one of the interesting small caps companies that I was looking at was the Pioneer Natural Resources, which actually yesterday we saw the prices also try to skyrocket. So, but again, it's all about having a mixed portfolio, small caps, large caps, so as to balance the risk.
Yeah. I mean, I think it's a difficult one, because I always come back to the fact that when you look at historical charts and you chart, say, the S&P 500 against the FTSE 100 or against the Russell 2000, or it's always those big companies that really dominate. And so it feels like those periods of outperformance are generally quite fleeting. This is a chart here that has let me just get rid of this first. This is the S&P 500 divided by the Russell 2000. So essentially the relative performance between the two. And yesterday, that big outperformance for the Russell 2000, sort of sharp decline in this relative performance. But look, this is the trend, right? So you are seeing outperformance for the S&P 500 and any periods of rebound for the Russell 2000. And this is when everyone starts saying, you should be long the Russell 2000 and not the S&P 500. Well, it always seems to resolve back in favor of the S&P 500. And like I said, when you're talking about companies that are heavily indebted and relying on borrowing versus companies that are just printing cash, as many of the top names within the S&P 500, in particular the Nasdaq, are, they will rely more heavily on borrowing. And therefore, when your 10-year yield goes up, so the cost of borrowing goes up, that's going to be difficult for small companies. So it's weighing up whether the benefits of these tax cuts outweigh the rising borrowing costs or not. And if you look at this wider trend, you can see generally we do have this positive correlation, which would point towards this latest pullback potentially not necessarily being the beginning of a new trend that sees the Russell 2000 outperform. And instead, likely, I think that trend does kick back in soon enough, especially if the borrowing costs and the treasury yields continue to rise. But certainly a sharp move lower as the Russell 2000 outperformed yesterday. But I'm still a little bit skeptical as to whether that's going to be the beginning of a new trend. And this highlights the outperformance of the S&P 500 against all European markets. But you'll notice at the bottom of the chart, this is a very long time frame, right? We're looking back to 2017. And so yesterday we saw a pop in terms of European markets, and then we saw it pretty much all reverse. We saw many of the markets start up with like 2% gains, and then they just gave all of it up. And certainly there's some major question marks about US-European relations in terms of trade. So I would say if you see outperformance over the near term for markets against, say, the S&P 500, generally it doesn't really last. And certainly, unfortunately, me being in the UK, the FTSE 100 just isn't reliable as the S&P 500 or any of those US markets are. So generally, periods of outperformance for the UK are relatively fleeting. You have to look at those long-term relationships and try and find the best markets to trade. And US markets historically have always been the best for the bulls. So let's look at the FX markets. And in actual fact, let me just quickly, I know that we've been talking about some of those sort of relative charts. I just want to bring up a couple of these sort of indices just to show you it in terms of, we don't trade relative charts so much. We trade the absolute price. So this is the bull market we're seeing here in the S&P 500, that big bullish engulfing candlestick that's looking like it's going to close this week out. And that rally up through into record highs that we've seen with the move through resistance here at 58.82 is continuing that bullish trend. Each pullback seems to give us a buying opportunity. On this occasion, we saw a very deep pullback towards that swing low of 56.73. Came very close to it. We hit the 5,700 mark, but now we've pushed onwards and upwards. And so that stepped move higher means that when we do see pullbacks, generally, I think the bulls are likely to step in once again. But the question mark is, when will that pullback come? Because we've seen some pretty momentous news. It's come off the back of a little bit of weakness. So I think there's a good chance that we do see plenty of optimism for an extended period rather than just like one big day of gains and then a pullback. Do you think that we're going to see markets push sharply higher from here, or do you think we're going to see things calm down a little bit? Certainly US markets in terms of futures are a lot cooler today than they were yesterday.
I think this is relative, but my view is we am anticipating maybe a kind of a correction, especially for maybe the few months remaining before Trump takes office, and then thereafter we might see maybe the markets react the same way they reacted to his win. So myself, I'll be looking for pullbacks or corrections, and then positioning myself accordingly. So what I'm saying in a nutshell is that in the next few months, maybe December, you might see a correction, and then in January, around January, there when maybe Trump takes the oath of office, we might see the bulls taking charge of the S&P 500. So that's my sentiment. That's how I'm looking at it.
Yeah, and I mean, when you're talking about a sort of correction, are you talking about a correction in the sense of like a traditional correction, like a 10% pullback, or are you just talking about a retracement within an uptrend?
A retracement within an uptrend.
Yeah, I can't see a 10% pullback, that's for sure. And bear in mind, right, like you're going to see different pullbacks. All markets have pullbacks and retracements within it. And generally, the size of that pullback will be dependent on how the market is feeling at that point in time, right? So when the market's feeling very positive like this, your pullback is going to be absolutely minimal. Sometimes when you're seeing sort of bigger jitters, you can see wider retracements coming into play. I would argue that given the way people are feeling at the moment, there's a good chance that when we do see that retracement coming into play, it might not necessarily be a super deep Fibonacci one like a 61.8 or a 76.4 fib. Instead, it's probably going to be a shallow to mid-sized retracement when it comes into fruition. Let's jump into the FX space because this is a really interesting one. I would say arguably stocks are easier in terms of stock markets are easier to predict than FX. You know, arguably you're balancing two different sides of the story here, right? Because you have to choose two different currencies. But certainly the big outperformer yesterday was the US dollar. And interestingly, it's the New Zealand dollar, which is now over and above that US dollar. Yeah, so major strength for the New Zealand dollar. I'll try and get into sort of picking the bones through exactly why that might be. But elsewhere, you've seen some strength in terms of the Australian dollar, the Canadian dollar. The bottom of the pack are those other so-called havens, the Japanese yen and the Swiss franc. And then the euro above that with the pound largely flat over the period. So this isn't just trading against the US dollar. These are sort of indices of each of these currencies. So it also takes into account their relative performance against each other. But notable that we've seen some strength for the New Zealand dollar as well. This is a very messy looking chart. I was questioning whether to keep this in or not, but essentially when we're talking about yields, and we've seen this rise in terms of the US 10-year yield, that rise comes off the back of the view that we're going to see less rate cuts in part, right? And so when you see shifts in terms of expectations for interest rates, in terms of less rate cuts or more rate cuts, that will impact the 10-year yield and many of the different yields for that country in particular. So what you can do for FX, I find this particularly useful, is you can chart the ratio between the treasury yield, so the 10-year yield for the UK against the 10-year yield for the US, and overlay that with the currency pair, because then you get an overview on the relationship between the treasury rates between the two markets and see how that influences the FX pair. And you can see here they do track very well. Many of them. They're not all perfect, but many of them do track very well. And you can try to find periods where you see perhaps the relative yields moving away from the actual price itself. So one notable thing here is that you can see bottom left, that move between the Australian dollar and the US dollar, and then the Aussie and US yields. You can see that actually we've seen a sharp decline in terms of Aussie dollar, but we haven't necessarily seen that in terms of yields. That points towards potential outperformance for the Australian dollar. And like I said, that actually fared relatively well. New Zealand dollar, you can see at the top right, you know, by and large, we've seen that track pretty well. So the outperformance wouldn't necessarily just come from the yield side on that front. Now, this is something that I wanted to bring up as well, and it raises a question for us to sort of discuss, and that is generally post-election, the first couple of weeks, you see strength for the US dollar when there's a change in the White House. And in part, that's because of uncertainty, right? And the uncertainty we're seeing right now is, would Donald Trump see a resurgence in inflation and suddenly the Federal Reserve have to take their foot off the gas? So could we see the same thing happen here, right? Which is the first 2 weeks after the election, markets are buying the US dollar, treasury yields on the rise. People are fearful that we're going to see a rampant rise in terms of debt. We're going to see the Federal Reserve take their foot off the gas. And then maybe after that initial period, maybe it cools down, and where equity markets are rising, generally that should mean a weaker dollar. So do you think maybe this rise in terms of the US dollar might be a short-term move, or you think this is going to be more protracted?
You see, like what happened yesterday, basically in terms of short term, we expect the spikes that we saw yesterday with the US dollar, because this comes as a result of investors trying to seek relative safety of the US dollar. So basically the aspect of the risk of sentiment, it's like what we saw yesterday, the dollar index spike. So in short term, looking at a strong dollar, but in the long term, basically, if trade tensions and maybe tariffs hurt the US growth, or maybe probably if the deficit rises significantly, the dollar could weaken over time, especially if inflation outpaces the growth. So short-term, bullish dollar, but long-term trajectory, basically it will depend on actual policy developments, the Fed actions, and things to do with the inflation dynamics.
Yeah, and it's interesting, right? Because all of the policies that Donald Trump's trying to bring in is like, you know, America first. And so America first can mean businesses having to bring in their operations back to the US. America first can mean that their equity markets are going to outperform, and that's what I expect. So we're kind of looking at a position where it's like the US equity markets are the only game in town. And if that's the case, then everyone starts pouring their money into the US. So that can be beneficial for the US dollar. But like you said, you know, I do think there is grounds for further upside over the near term. But I do think that, you know, much of it is born out of this idea of increased inflation and things like that. That's not guaranteed. So once we see sort of some changes that he imparts, and maybe it's not as hardline as people might think, or maybe inflation continues to move towards the downside, then that could ease some of those concerns. We see the 10-year rollover, and we see the US dollar also weaken. This is a chart that we previously looked at. I'll just briefly chop through a few of them here. So first and foremost, this is sort of highlighting what countries have the greatest exposure to Trump tariffs in terms of who exports the most to the US and who imports the most. Notably, the big exporters to the US here are Mexico and Canada. So certainly they're two currencies that we want to be looking at going forward. And it was notable that actually we saw a relatively strong performance for the Canadian dollar yesterday. And we can briefly discuss this within the energy section, but this is in line with the idea that, you know, I know there's a lot of talk of them breaking down barriers, but actually this Trump coming back into power basically kickstarts the Keystone XL pipeline between the two countries, and we're going to see a big flow of oil and gas coming into the US refineries from Canada. So that could bring down costs. That could bring down inflation if they suddenly get even more oil and gas coming from over the Canadian border. So the Canadian dollar did relatively well, but the Mexican peso, we saw weakness. And you can see that here. Emerging markets really hit heavily. And there's a number of different reasons for this. I mean, look, from my perspective, in the UK, there's a heavy reliance on, say, the services sectors. We're not necessarily massive manufacturers. And so the idea of tariffs on UK goods isn't necessarily as much of a problem compared to maybe a country that is heavily reliant on manufacturing and then selling that onto the US. So you're going to see that impact some of these currencies. You're also going to see a lot of these countries have got debt in the US, and so a higher dollar means higher debt repayments coming online, and higher yields also mean that we're going to see debt really at the forefront of the agenda going forward. But the Mexican peso, as you can see here, is a really interesting one to watch. And we just quickly bring this up and highlight something that really sort of caught me off guard when I saw it. And that is that if we look at the last time that Donald Trump came in, once the election happened, we saw this big pop in terms of the US dollar against the Mexican peso. Of course, everyone talking about build a wall and things like that. We're going to make them pay for it as well. That was all the rhetoric. But what happened afterwards? Well, we actually saw the US and Mexico gain a very strong trade relationship. And we ultimately saw the US dollar against the Mexican peso selling off over a protracted period. We went from your sort of 22 down all the way down to your 17.5. So massive sell-off in terms of the US dollar and strengthening in terms of the Mexican peso. What happened yesterday? Well, look what happened. We saw an initial sharp pop around this election. So you can see it here, massive pop, US dollar strength, Mexican peso weakness. What we're seeing now, we've seen it entirely reversed and starting to sell off. Is this the beginning of something that we've seen before, that same kind of post-election move that we saw under Donald Trump before? Let's get it back up again. There you go. Is it the beginning of this? It's probably too early to say, quite frankly. But I would say it's really interesting that initial rise faded. So when we're talking about the big losers yesterday, this ultimately didn't end up that way because we saw this big reversal and it's continuing apace. So this is going to be one for traders to watch out for. Certainly, if we're looking at a potential reversal, for me, I'd want to start breaking all the way back down through this low of 19.1. But certainly before that, you're going to be looking out for this swing low that we can see probably better on the 4-hour chart, which is 19.775. So dollar Mexican peso, certainly one that maybe many of you don't particularly trade very often, but it's something that is going to be particularly interesting as we go forward within Trump's period in power, because Mexico is essentially on their doorstep, and he has struck a decent agreement with them to the extent where many Chinese companies like BYD, their car maker, were essentially planning to just set up a new factory over in Mexico, take advantage of the trade relations between the two. And that's how they get around tariffs. I'm pretty sure that Donald Trump will have something to say about that. This is another chart that I was sort of pulling together yesterday, which I found particularly interesting. Essentially, the trade balance between some of the major nations against the US. And what stands out to me is, firstly, we can sort of look at the relationship with China. Over the course of his presidency, towards the back end of it, you did see a narrowing in terms of that trade deficit, but it is a massive one. So you can see why he's trying to address that. You can also see that Mexican trade deficit continuing to move towards the downside. Is he going to shift the narrative on that front? You can also see the euro area. So the euro is really at risk here because you see the grounds for him to take action. You've already seen Donald Trump coming out with comments of those ilk that basically the Europeans are taking advantage of us. Well, the UK may still be in Europe, but we're not taking advantage of you, because that red line on the top, you can see the UK out of these countries is the only one to have a deficit against the US. So the US has a trade surplus with the UK. That potentially stands the UK in decent stead to be able to strike some sort of trade agreement with the US on good terms, because Donald Trump doesn't feel so aggrieved by the relationship between the two. But certainly if we're looking out for targets for Donald Trump, this chart actually gives you a good breakdown of that. And this is one that I really wanted to highlight, and that is the breakdown on what countries are reliant on manufacturing exports. You know that the likes of Australia and New Zealand are exporters, major exporters. But what do they export? They export mining products. They export in New Zealand a lot of dairy and agricultural products, not necessarily so much the stuff that's going to be tariffed as much. And so when we're talking about that outperformance yesterday for New Zealand, part of that and Australia comes down to this, right? So they're not necessarily going to get hit by tariffs, and they might actually be in a relatively sweet spot where they're getting the advantage of the Chinese recovery. And certainly we're expecting to see the Chinese continue to push forward, because they're not going to get much help from the US. So they're going to have to do it on their own. So they're probably going to get closer relationships with the likes of Australia, the likes of New Zealand. And meanwhile, Australia and New Zealand, as you see here, less reliant on manufacturing exports. So there's a good chance that they essentially do relatively well coming out of this. And so let me just quickly bring up the likes of the New Zealand dollar against the US dollar in particular. So this is the chart for the Kiwi dollar. And so what we've seen here is this downtrend playing out, but we did see a nice pop closing much of that weakness. So the downtrend still does play out on this 4-hour chart, and you can see it from a wider perspective, but we are coming into a key area of support. So when we're talking about the possibility of near-term strength for the US dollar that could play out over the next couple of weeks, that would be playing into this narrative here. But at the same time, you know, you do have a key area of support there. If we do see the dollar coming back into sort of a period where it starts to weaken, then this would be an interesting one to be following. If we're talking about areas that are particularly weak and particularly strong, well, the euro, of course, we were talking previously, a big widening in terms of that trade deficit the US has with the Eurozone. So it's essentially in the sights of Donald Trump. And you're looking at it against the New Zealand dollar. We're seeing two big, sharp downside days. We are trading within essentially a wide range where we've come into the sort of top end of it here. Actually want to move this to the right because that's putting me off there, 179.1797. So this area, sort of 184s, 182s, that kind of area, generally we have seen it topping out. We haven't really been getting much traction over the last year. And so, you know, could this be the beginning of another pullback into the bottom end, your 175, 176s? Potentially. Certainly the key level to be looking out for to the downside is going to be your 178s, because until that breaks, we still do have this sort of high low that's been playing out over the last month. But I think this is a really interesting one to be watching out for, alongside the US dollar against the Chinese yuan. Of course, the Chinese yuan is going to be really in the limelight given everything that's happening between the US and China. And certainly when we're looking at the recent trajectory, it's been in recovery mode following this sell-off that has been playing out as China's been getting into a groove and announcing a number of stimulus measures. But now it appears to be the case that maybe it's bottomed out here. We've seen this rally, the shallow pullback, and rallying up once again. We're rolling over the near term. But certainly this recovery phase, I think there's a good chance that we see the bulls potentially coming back into play above this 7086. Certainly if we break through that level, then questions are being asked once again. But I think the US dollar against the Chinese yuan is another really interesting one that we're going to have to be following as we go forward.
I think also another important pair to look at is USD South African Rand. I think you can pull out the chart. Yeah. USD South African Rand. It's a very interesting pair as well.
Yeah, definitely. So this is the daily time frame, very clear downtrend in play here. And despite the sort of rebound that we did see yesterday, we're rolling over in a pretty sharp manner. And actually, if you look at this, I mean, it's almost like round like a football. That is absolutely rolling over in a beautiful way. And we've taken out this key support level around your 17.48. So that initial pop really starting to fade. It does ask questions for the US dollar strength as a whole when you see this across many of these different currency pairs. But certainly for the dollar against the rand, it's coming into a key support level down here at your sort of 17.36. That if we see a break below that, then it's a continuation of this wider trend once again, following this retracement that to me looks like a pretty deep one. That's probably a 76.4 fib down there. Let's see. I just feel like I spend my time trying to guess exactly what levels are. There you go. Yeah. So a 76.4 fib. And then rolling over once again. So, this doesn't necessarily look super bullish for the US dollar for the time being. This is a highlight of that widening shift in terms of what's happened for expectation for the Federal Reserve. But look at what's happened for the likes of the ECB. We haven't seen that same shift in terms of an expectation that we see less rate cuts. And so with the Fed shifting the narrative and the direction of travel for rates and the likes of the ECB not necessarily in that same position, we don't have the strong economy that they can rely on within the Eurozone, then that provides the basis for weakness for the likes of euro dollar. If we bring up euro dollar and see exactly how that's been playing out of late, we can see, there we go. We can see here that we've been seeing some really sharp selling pressure thus far, coming into a key support level of 1067. Let me go out onto the weekly time frame. You can see here that we have been sort of grinding higher, and certainly if we break down through this area of support, your 1066 down to your 106, essentially, those areas are really critical, and it starts to really undermine this rally that we have been seeing and point towards a potential for euro dollar to roll over if we can break through those levels. But certainly, we have seen that differential shift here. So rates going to be higher in the US, rates going to be lower in the Eurozone. But bear in mind, we already have seen that dynamic shift. So it's a question mark of whether that dynamic will continue to shift. And the Federal Reserve meeting later today is going to be key for us to be able to gauge expectations. We have seen some commentary about gold from Esther. She wants to know about gold. Well, we know that gold is a massive one for our clients. So we want to spend a bit of time talking about that and seeing exactly where we go from here. Interestingly enough, I said I thought that gold probably did well, irrespective of the outcome. You said the same. I've seen a lot of different analysis from different banks that said exactly the same. That's not how it played out. We saw sharp downside for precious metals yesterday. This isn't it, but we can bring up the chart for gold and show you exactly how things have played out and what things are looking like at the moment. So this is the gold chart, and we can see on the hourly time frame exactly how it's been playing out. It's been a bit of a difficult one for the gold bulls, that's for sure. Timothy, what you feeling for gold at the moment? Is this going to be a short-term blip? Is this going to be something that's a wider move towards the downside for the precious metal?
I think for me at the moment, the key being with gold is, first of all, to understand that there are so many factors that influence the prices of gold. But anytime we have political shifts, like what we had yesterday, it also creates some what I can call ripple effects. So any major political change can create a lot of uncertainties in the financial market. Of course, gold is very sensitive to that. So if I'm to look at gold, basically on what we have the US election, I can look at it in maybe three perspectives. First of all, I look at it in terms of Trump and Trump's economic policies, what he has. So if you look at Trump's approach to the deregulation, basically this might affect investors' confidence if he is going to implement that. And their confidence or lack of it could actually have an impact on gold prices. So we have seen with the Trump win, it might lead to a mix of policy driven uncertainty, inflation, geopolitical risk, which could increase the demand for gold prices. So, like you have said, mostly the prices of gold, we are looking at more higher prices. So, what is happening with gold is currently, for me, is just a dip, because if you look at probably maybe you can put the monthly time frame. You can put the monthly time frame. So from the monthly time frame, we are still very, 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 very bullish. So what I'm looking at is just, for me, I'm looking at maybe retracements to maybe probably if it has to dip around maybe 2400 levels thereabout, guided from the weekly time frame, because I mean
all the way
from
down
the
to 2400. You're thinking, yeah?
Yeah, around 2400. Then now we can shift to maybe probably the bullish momentum. But again, if you look at it in terms of monetary policy, basically we know that Trump sometimes tends to have what we call loose monetary policy, relentless spending, pushing the economy into override, which might again ignite inflation. And if this happens, we might see the dollar weaken. And if the dollar weakens, typically we'll see the gold prices skyrocket. Looking at it in terms of geopolitical tensions, we have seen Trump trying, he actually promised that when he takes office, he will end up the Russia-Ukraine war within 24 hours. So
Exactly, yeah.
we saw the statement he made yesterday. We had the statement he made yesterday. I think tonight, addressing Putin. Putin also responded as well. So it's quite interesting to see how this is going to unfold. But again, irrespective of what's basically going on, I'm looking at more bullish prices. So I'm looking at the dips, basically buying the dips. That's my view. And again, also
I mean,
maybe to add a point again, maybe to add a point again, looking at the historical patterns and future uncertainties, we have history doesn't always play relance, but again, during Trump's last term in White House, we saw gold prices taking a leap. So this might maybe probably repeat itself by maybe looking at different things like Trump's trade dispute with China, alongside with other strained international relationship. So this might again attract more demand for gold prices. So I'm still bullish, or I'm still looking at bullish gold prices.
Yeah, and I mean, look, like as you say, there's a huge amount that goes into what can push gold prices going forward. A few things that I would say. First and foremost, like you're talking about, geopolitical tensions and the like. I mean, ultimately, when you're in a position where people from, say, Russia are having their assets frozen or taken from them, it erodes their confidence in putting money into the Western world. And instead, people want to put their money into things like Bitcoin and things like gold, right? So there's been a massive ramp up in terms of spending from especially BRICS nations within their central banks, stockpiling gold. That has provided the backbone for the strength that we've seen in terms of the precious metal. In terms of, there's a few charts I wanted to show you here. First and foremost, we're expecting to see Treasury yields roll over if you expect to see interest rates continue to cut. And the reason why Treasury yields are important is generally people like to have assets like gold or bonds in their portfolio. But if bonds are giving you a good yield, then you're less attracted to gold, right? Because gold doesn't have a yield. It just goes up or down. There's no guaranteed rate of return. So generally, when we see yields roll over, it means that sort of risk-free return starts to fade. So the interest in bonds is lessened. People move more towards gold. So yes, we're seeing yields rise at the moment. But as you can see here, historically, yields should move lower when the Federal Reserve continues to cut rates, which we are expecting. But of course, we've seen a bit of a shift recently in those expectations to a slower pathway. This is the relationship. And in actual fact, I hadn't seen this chart before. I just sort of came up with it yesterday, and I couldn't believe how closely it works out. Essentially, it's a relationship between the 10-year yield and gold overlaid with the US dollar. So right now, Treasury yields are outperforming gold, and that is helping to provide upside for the US dollar because you see money coming into the US as they're buying the likes of the 10-year. Will that last? Well, I'm not necessarily so sure, but certainly the trajectory of the 10-year will guide where the likes of the US dollar goes from here, and certainly expectation for gold. In terms of where we're looking in terms of the price, you're saying all the way down to 2,400. I'm a bit more optimistic, and maybe it's the fact that I'm seeing us perfectly tagging this 76.4 Fibonacci level and starting to move towards the upside. But I don't necessarily think it's going to be a protracted move towards the downside. Personally, I do think there's a number of factors aside from what's happening in the US that should drive this market towards the upside as we go forward. And certainly Donald Trump is all about spending, and higher spending means higher debt. Higher deficit means you don't necessarily feel as confident in the US economy. And when you've got all these currencies that are being devalued and higher debt, you then start to question whether that's the right place to be, and people then start to turn towards the likes of gold as a result. Let me just we just got to try and skim through this quickly. I know we haven't got a huge amount of time, but this is another part of it as well, right? Generally, when we see the initial rate cut from the Federal Reserve, I've put it on the log chart just so that you can kind of see in greater detail on the top. But that is the price of gold with the lines marking the beginning of a new cutting cycle. And generally, it either marks the beginning or the midway point of a bull run for gold. We've just started a cutting cycle, so I don't necessarily see this as a top for gold. I think we're likely to be seeing a pullback set within a bull trend. And as you can see here, the spending for Donald Trump is likely to ramp up debt. The yellow line is debt to GDP ratio. And if you overlay that with the price of gold, I would expect to see the debt to GDP ratio rise unless he manages to see GDP soar. But ultimately, higher debt, higher deficit should be good for gold, which is essentially the point that I was making before. Let's quickly touch on the likes of oil, the likes of copper. What are you thinking in terms of that? Because in actual fact, oil was a really interesting one yesterday. We saw it selling off originally, then we saw it essentially regain ground. It ended up near enough flat, and it just made me think markets don't necessarily know what the implications are for oil.
Yeah, you see, when we talk about oil, yesterday what happened, we saw the price of oil dip because of the strengthening of the dollar index. So I'm looking at I think the price of oil to around 65%. I mean $65 per barrel. If you look at it from the weekly chart, I'm looking at the weekly chart. So that's where we have some major support around $65, $65.24 dollars per barrel. So if we have a major break below, that point, we might see the prices of oil tank. But again, we have seen in terms of the policies that Trump is advocating, if he is going to end the geopolitical tension, especially in the Middle East, then what this means is that he will stop the interruption of production of oil, meaning that the supply of oil will be higher, and then maybe probably the prices of oil are going to, when the supply is high, we expect the prices to dip. So the reason why I'm looking at that key level about 65.24. So if we have a major break below that, we might see more lower prices for oil, and surprisingly, they can go even as way far as 43 per barrel. What's your thought?
Yeah, I mean, it's certainly when we're talking about whether he's going to bring higher or lower prices. People always say Donald Trump's good for oil, right? But he's good for oil companies. I think there's a chance that he potentially launches deregulation. He makes it cheaper for them to be able to produce, potentially lowers taxes. Essentially, he wants people to produce more. And in actual fact, if we're talking about markets really fearing that he's inflationary, this is something that he can do to try and bring down that inflation. If he can make it cheaper for people to be able to produce, easier for companies to be profitable, then it incentivizes them to pump more. The US is already the biggest oil producer in the world. and there's an expectation that he's going to push for further production. That's not good for oil prices. Like you said, you're looking down towards the 65, 66 kind of area on WTI. By and large, you're looking at a market that has been sort of, we've seen a lid kept on it recently, really. I mean, up to sort of your 80s, but thankfully we're not seeing that kind of rally that we've seen up in the 22s, because that would be a big problem. And certainly oil prices are going to be absolutely key. If you're trading any of these other markets, if you're trading gold, oil's relevant. If you're trading the US dollar, oil's relevant. If you're trading stocks, oil's relevant. And the reason for it is oil prices and energy prices can drive inflation. And if we see a massive surge in inflation, then the amount of rate cuts from the Fed is going to change, and the outlook for interest rates as a whole is going to change globally and as a result. So certainly we need to see him keep a lid on this. That should provide some sort of negative bias in my mind, because it's in his interest to keep oil prices relatively low. We're currently respecting the 72, 77 mark. And certainly if we break through the 70 support level, then that'll be key. But like you said, you've got a really interesting area of support noted on a weekly time frame. And if we break through that, then maybe we see a significant move towards a downside for oil. But we need to see that break, because it's not necessarily happened. Just briefly, we saw some significant weakness in terms of copper prices. We're recovering quite significantly. But of course, this really comes down to the possibility that China is going to suffer economically from what's happening in terms of US-China relations. China is the biggest oil producer. China is the biggest copper consumer in the world. 52% of the world's copper is demanded by China. And therefore, if the Chinese economy is not pushing sharply higher, then copper demand is likely to suffer as a result. So we're rebounding at the moment. We're likely to see some significant conversations around potential Chinese stimulus this week. But certainly this is one to watch, because maybe we fade this. Maybe this rolls over once again. But it's going to come down to the commentary coming out of China. It's going to come down to whether markets believe that this is going to be the thing, the full sweep for Donald Trump, whether that's going to be the thing that essentially sparks another period of weakness for the Chinese economy, and by its nature, weakness in terms of commodities such as copper. And I think we're going to wrap this up with a little bit of a chat about stocks. We did go through a few of these. I'll just quickly show you a couple of slides, and then we can just sort of pick a couple of stocks between us. So Harris, kind of irrelevant now, but these are the areas that are supposed to benefit. This is according to Bank of America. These are the sectors that are supposed to benefit from Donald Trump's tax benefits. So you can see here the lower tax amounts. In particular, yesterday we saw strength from the financials. So here is a chart that I brought up previously as well, highlighting financials do well under Donald Trump. In his first period in charge, it was the financials that outperformed on all of the first 3 years, and IT really coming second behind that. And we saw that yesterday with financials, which are bottom left. JP Morgan, it was like 12% near enough. Wells Fargo up 13%, Citibank 8%, the Bank of America 8%. So across the board, US financials did well. Don't necessarily think that that is the end of it in my mind. And you can see that here. Financials did the best. Industrials second to that. Consumer discretionary third in line after that. But as we can see here, historically, over the course of Donald Trump's power, his reign over the course of 2017 onwards, it was the financials that typically were reliably the best. And they were the ones that outperformed yesterday, as we alluded to in the previous webinar. So certainly that is something that I wanted to bring to your attention. Here's a host of names, but some of them won, some of them didn't. We didn't necessarily do great in terms of like Walmart and Home Depot in particular, but a lot of those winners did really win out. So let's just grab a few names as we close this out and see what they're looking like charting wise. So I think personally, the likes of Goldman Sachs, JP Morgan, they are going to do particularly well out of this. The reason for it is interest rates won't be cut as quickly as or as early as possible or previously thought. So higher interest rates, good for US bank margins. At the same time, we're expecting to see the economy doing better. It means their loans, we won't see as many bad loan provisions. So again, that's good for the business. And then you're likely to see friendly regulations as well from Donald Trump going forward. So everything really puts the financials, and in particular the big banks, in the sweet spot. And the financials that also have trading departments like JP Morgan, Goldman Sachs, are also going to be able to benefit on the trading side from the fact that, so I haven't actually got the chart up, from the fact that markets are moving towards the upside. And generally, you see those big investment banks outperform when markets are doing well. Well, the stock's doing particularly well. Here's the monthly time frame. It's been on an absolute rip over the course of recent years, and we're seeing that continue apace here. A big gap higher, a continuation of that move. And I think this is a stock to really keep an eye out for going forward. The likes of JP Morgan, the likes of Goldman Sachs. It'll be a similar kind of picture here. There you go. It looks pretty much exactly the same. I don't think this will be the end of it. And certainly from an investment standpoint, I'm not saying that this is going to go up in a straight line from here, because we do always see retracements within these moves. But from an investment long-standing standpoint, I think the next few years should be good for these big investment banks. Timothy, what's the chart you want to throw up and talk around?
Yeah, for me, I'm looking also at the pharmaceutical companies, and because the reason I'm looking at the pharmaceutical companies, especially the Pfizer, Johnson and Johnson, if you look at this, the Trump policies, which have generally favored the pharmaceutical industry, so we might see continued support and less pressure in terms of drug pricing. So, like if you look at Pfizer, it's nearing a very critical support level as well. So it's something to worth looking at. If you maybe probably pull the Johnson and Johnson chart as well.
Yeah.
So also the Johnson and Johnson chart, looking at it, maybe price digging deeper, slightly around 144 thereabout. Yeah, we have that. We have that trend line. Yeah. So
do you think that we're going to continue to see selling pressure coming in here?
Yeah, if we break that trend line, we might see more higher prices, because I'm looking at it in the long term, not maybe probably it's the stock that I'm putting in my watch list. Not that I probably want to invest in it right now, because I know after the swearing in of Trump, these pharmaceutical companies might perform. They might outperform.
What about Tesla? You were talking about Tesla. That's been one of the big stories, really. I mean, it's got everything, right?
Yeah, Tesla actually yesterday it jumped about. Right now we are talking about it's up about 17%.
Wowza!
Yeah,
not bad. Yeah, I mean, I think Tesla is so interesting because it's got everything, right? It's got the AI story. It's got the fact that you've got the guy who runs it is essentially going to be part of the administration. And it's got the manufacturing story, right? So if you manufacture in the US, you can do well. You can also manufacture in China itself, and you should be able to get good access to the Chinese market. So they're really in a good position. Whether they are going to be able to get out this period where they're constantly in sort of price wars with Chinese manufacturers, whether this changes that remains to be seen. But certainly, I think Donald Trump will likely be quite receptive to having Elon Musk in his ear, telling him exactly what he wants in terms of policy going forward, but certainly pushing sharply higher here. And as you alluded to previously, right, this was a company that might do well irrespective of who won the election.
True. So I have a couple of...
Yeah, go on, sorry.
Also in the energy sector, it's also looking at ExxonMobil in the energy sector. So just a portfolio of stocks that are monitoring the ExxonMobil in the energy sector. We have the Chevron as well. It's also in the energy sector. When we come to the defense industry, Lockheed Martin.
Just briefly on the oil one, it was interesting yesterday. There was a lot of talk about Donald Trump because he wants to pump so much more. It's going to be really bad for the energy names. We didn't actually see that come to fruition. You can see that it actually held up pretty well. And I guess that's a view on the idea that, yeah, even if we do see increased oil production and maybe lower prices, you could maybe see some friendly regulatory stance from Donald Trump, because if he wants people to pump more, he's going to have to give them an incentive to do so. So so far it's held up pretty well, and certainly it continues to play off the back of this trendline support that's held up over recent months.
A key point to note is I think Trump is favoring the traditional energy, but Harris was favoring the green energy. So the reason ExxonMobil, I think it's one of the traditional energies. So the reason why I'm really looking at it, giving it a very keen eye in terms of seeing how the prices are going to unfold.
Yeah, definitely, because we're going to have had to have some pricing coming into this event of a potential Harris win and what that might do in terms of policies for some of these big oil majors. One I wanted to also mention was Coinbase. I think that was a really interesting one yesterday to talk about, like making the US the global hub in terms of crypto mining and things like that. So the fact that we've got one of the sort of biggest brokers out there, US located, we saw this massive pop up 30%, I think 31%. So again, another big story playing out within this. So plenty of major ones. I just wanted to bring up this one. What about the VIX, right? We've seen the VIX moving, let's see, down to the volatility index. So big decline in terms of the VIX. Let's look in terms of the long-term trend. And you can see that generally spikes in the VIX are relatively fleeting. And generally we do see it sort of on this downward trajectory back down to the lows while we wait for that next big spike in terms of volatility as a result. Remember, the VIX is generally, the VIX is essentially representing the volatility of the S&P 500. The S&P 500 generally goes up, right? And we see these fleeting moves towards the downside for that market. And that's when you see that sort of pop in terms of the VIX. But comes as no surprise that we see a depressed move for the VIX. And as long as we see this sort of upbeat outlook from equity markets, you'd think that the VIX would continue to be relatively depressed. Is there anything else you wanted to cover? I know that we've run over again.
I think as we wind up, there is also a sector that we cannot be able to ignore, and this is the infrastructure sector. We know Trump has always consistently pushed for infrastructure development, and in this case, you can look at Caterpillar. It really shot up yesterday. You can see how the price action.
And an expectation that we're going to open higher from there as well. So, yeah, certainly this theme is playing out really well, and you're seeing that breakout through resistance here for Caterpillar, with an expectation that we're talking about infrastructure spending in the US. We're talking about more sort of traditional infrastructure spending, and Caterpillar seem to be very well positioned within that. So, yeah, you're right to highlight that as one of the major winners for this market. And certainly for investors, they're going to be looking at companies like this and thinking, Donald Trump's going to see the US economy boom. And these are exactly the kind of companies that are perfectly positioned to be able to take advantage of that.
So, and this actually answers one of the questions I can see. Someone saying that Trump has promised to cut the spending. Do you think this is just political posturing? So we might probably. This is relative, because if it's going to pump some money in terms of developing infrastructure, again, we might see it's relative. We might see increased spending or maybe relatively spending, but there is no way a government can run without spending, in essence. So for me, it's quite a bit relative. I don't know how you looking at it. Maybe Josh, do you think he's going to cut the spending?
Well, do you know what? I think he'll try and cut back, but I think the places he'll cut back are, he's already got Elon Musk in that he said is going to trim back the government. So maybe that spending is like just trying to trim the fat within Washington, so to speak. I don't necessarily see him cutting back in a major way, in a way that's going to particularly help the deficit personally, because all of the analysis that I've seen doesn't necessarily signal that he's going to be able to make any inroads on that front. And for the most part, he seems to not really care. I think for the good or the bad of it, all he cares about is how it looks for him in terms of the stock markets. I think if equity markets are doing well, then all of his rich friends are doing well. And, fortunately, we're in a position where we can trade it and we can try and do well alongside them as well. But certainly my experience of covering markets over the course of his previous tenure saw Donald Trump essentially reminding you every single time that we saw a record high. So he is keeping an eye on the charts just as much as you will be. And just to wrap it up, Esther was also mentioning, we talked about gold. We've covered that a lot, but also the US 30. So the Dow Jones Industrial Average. Interestingly enough, we're actually seeing NVIDIA added to the Dow Jones Industrial Average. So that's notable considering the fact that in the past there were only 2 of the Mag 7 names in this index. But we're seeing a move up towards the upside, coming towards this trendline resistance. Could that be the kind of area that we maybe see some profit taking coming into play? Potentially. Look, I mean, you see this market essentially swing into sort of peaks and troughs. So at some point, we're going to see some sort of exhaustion move. Like I said, though, generally, I think when you've got a market where everyone seems to be on side, at some point you see it retrace, but I don't necessarily think we're going to see a major retracement. So we don't know that this is the top, but let's say this was the top. Let me just get this and put it into a sort of shallow retracement zone. So you can see here, if this was the peak for the near term, you'd just be talking about a shallow retracement in my mind. So different ways of playing it out. I just don't necessarily see the grounds for or the basis for a major pullback for these markets. For the coming years, I think it's going to be bullish for these markets. And certainly when we've highlighted in chart form the fact that post-election periods generally good. A full sweep for Republicans, pretty much a best case scenario. The back end of the year is good for markets, end of, but in particular in election years, it generally kicks off in November. The period between election and inauguration is generally bullish for markets. So everything pushes in the direction of markets doing well from here. And therefore the Dow Jones Industrial Average, the S&P 500, the NASDAQ, the Russell 2000, I'm bullish all of them personally. Doesn't necessarily mean it's going to move in a straight line, but certainly I think the moves that we saw yesterday with a record high and a record post election performance for the S&P 500 points towards the feeling within the markets that this is a really good time to be looking towards US markets in particular. Shall we wrap it up at that, Timothy? I know that you've got another engagement after this. We've run over by another near enough 20 minutes, same as last time around, but we tried to add as much value to you guys as we possibly can. This video will be available on both the main Scope Markets and the Kenyan Scope Markets YouTube channel. I hope it's been useful for you guys. It's been good to take a look at this and deep dive into some of these different areas as we discuss the fallout for an event that is essentially going to make the future, right? This is what we're going to be talking about for years to come. It's all about Trump. It's all about his policies. And hopefully it can be beneficial for traders like you and I. Thanks a lot, Timothy, for joining me. Do you want to say your goodbyes?
Thanks a lot, and goodbye. It was an insightful session. So I believe we have added value to our traders, and I wish them all the best in their trading.
Lovely. Cool. Cheers. Have a good one. Have a good day, everyone. Thank you.
Bye.